Hi, everybody, and thank you for attending our long-term care webinar. Just wanted to quickly introduce myself. My name is Pat Rufo, one of the partners here at Breakaway Wealth Management, and I'm also joined by my partner, Dave Kraus. Just a little bit of background about our team. We're a full-service firm that focuses on holistic financial planning, helping families get organized from a retirement planning, estate planning, and investment standpoint. We've helped many families transition through major life events by creating customized plans and investment strategies for clients to optimize their wealth and achieve their specific goals. More often than not, we notice that new clients who we start working with think they have an idea about long-term care planning and costs, but there have been a number of misconceptions that are out there, and today we would like to share some information and give you a few takeaways that hopefully benefit you. Long-term care is an extremely relevant piece of the puzzle to financial planning. And as you may or may not be aware, healthcare costs continue to grow and have become a major concern for families entering the retirement phase. Also, I'm sure some of you have dealt with aging parents or family members and realize how expensive it can get. This is why we wanted to bring in Andy Wrigley from Lincoln Financial to talk all things long-term care related, as well as show us some solutions to help ease the burden of healthcare expenses in retirement. Andy, can we start off just by defining long-term care? I find many clients believe long-term care expenses are covered through Medicare. I know that's a common myth, but can you expand on that?
Yeah, absolutely. And again, I'll thank everyone for participating in this call, and Pat and David, thanks for inviting me and having me here. I'm going to share my screen. Give me a thumbs up when you see it. I'm just a big believer in visuals, so I'll walk you through what long-term care is, but I want to make sure that those that are participating also have the ability to see what we're talking about here. All right, perfect. Thank you. So when we're looking at long-term care, right, it's important, and it's why Pat asked the question. This isn't meant to be some type of a diploma that you hang on the wall for display, right? What we're talking about is putting strategies in place, potentially incorporating insurance that can be put to use if and when the challenge of a long-term care plan is needed and met. Now, the definition that we're going to share with you is per the IRS, right? And the reason why we care how the IRS views long-term care is that one of the major benefits, one of the attributes of these strategies, and why I believe so many people have started to embrace this in their long-term planning, is the efficiency that it brings to the table, right? Our goal when we put these strategies in place is to show you a way to stretch your dollar as much as we possibly can to limit your exposure of out-of-pocket expenses when it comes to paying for this type of care. One of those efficiencies that we'll speak of is from a tax standpoint, right? So rather than you using your own savings, rather than you using your own portfolio to pay for care down the road, where any distribution you take from that portfolio could be taxed and taxed quite significantly, one of the advantages of using a insurance plan is to give you access to dollars that are available to you in a completely tax-free environment. So again, long reason as to why I'm about to share with you this IRS definition for long-term care. So first and foremost, as the slide says, the IRS determines it's got to be a doctor that goes through the suitability process with you, right? Goes through this process with you to determine that you actually need care. Meaning it can't be you, it can't be your adult kids, it can't be Pat or Dave on your behalf calling up the insurance company and saying, all right, we're ready, send us the money. The insurance company would work with a certified physician. That could be your doctor. That might be the staff at a facility that you might be living at, if we're talking assisted living or nursing home. But either way, it's got to be a certified physician that says you've met this definition. Now, what that doctor is talking about is either a cognitive issue, so think something like an Alzheimer's, dementia, something of that magnitude, or it's a physical one. So if you think about a cognitive issue, what it will say is that you need substantial supervision due to severe cognitive impairment. What that means in English is that the doctor's saying, look, Pat, sorry, Pat, we're picking on you here. Pat, I'm no longer comfortable with you making it through your typical day safely because of this decline. You could hurt yourself, you could hurt somebody else, and we need to make sure that there's some supervision. That in and of itself would be enough to check a box and say, okay, we believe we've got a long-term care need here. If it's physical, Then we look at the box kind of with that red header on the screen right now. If it's physical, the IRS very clearly defines what's known as your activities of daily living. And there's 6 of them that they list. First being eating. Now keep in mind, that's not the preparation of a meal. Eating, in terms of a trigger on a policy, a long-term care, is can I get that fork from the plate to my mouth without assistance? Can I dress myself or bathe myself would be 2 others, again, without assistance. You look at transferring. Well, can I get out of this seat without hands-on or standby supervision? And then the last 2, toileting, which is the personal hygiene associated with the act of going to the bathroom. Can I get on and off a toilet without assistance? And then finally, continence, which is the 6th, and that's your ability to control your bladder. So physically, if you can't perform any 2, now it doesn't matter how you got there, right? I mean, we tend to think of long-term care for the elderly, right? Age has no place in the definition. It could be an accident, an illness, a procedure, or natural deterioration because of age. But if you can't perform any 2 of those 6, then we can check a box from a physical standpoint that we might have a long-term care event. And again, I said might, right? So the last part of this is timing. And Pat, this really gets to your question about Medicare and what they can cover and what they can't. The IRS is also very clear that long-term care insurance is not meant to overlap with Medicare. Medicare is really taking over for your healthcare benefits, right? Medicare is designed for acute care services. Think doctor's visits, hospital stays, procedures, medications. Once Medicare realizes that your recovery is going to take longer than 90 days, then it falls into the category of a chronic need, an extended care need, or a long-term care need, in which case Medicare says, not our responsibility. If that's the definition, then it becomes your portfolio that becomes 100% responsible for the cost associated with your care, unless you've purchased some type of private insurance. So again, 2 of 6 activities of daily living physically, severe cognitive, if we're talking a mental decline, and the fact that your recovery does not have to be permanent, but that the doctor that's diagnosing you says that they believe it'll be 90 days or more before you recover. That's how we can check the box. That's how we've determined that it's a long-term care event. And then any benefits of which we'll talk about become available to you to help offset the cost of that care. Hopefully that helps.
Awesome. No, that was helpful. Thank you for clearing that up. And now that we know how the IRS defines long-term care, can you tell us more about the various types of care, the cost of that care, and how we might build a policy for somebody?
Yeah, absolutely. So what I'll do is I'll bring up again a visual here so that you can see in terms of national expenses, right? And then we'll break that down because I know we're all in Jersey. I don't know if all of your clients on this call are in this part of the country, but clearly where you receive care, where you live is going to help determine the cost of what that care might look like. Now, this is broken into 3 categories, right? And that's the way I tend to think of long-term care, and I think it resonates with most. Do I want to age in place, right? As most people do. Now, Lincoln, the company that I've been working for the last 20 years, we've been selling long-term care insurance for the last 35. Almost 70% of our clients seem to want to age in place. They want to receive care in their home as long as they possibly can. So we'll talk about home health care. You've also got things like community care, like assisted living. And then probably the other end of the spectrum is a nursing home, memory unit, right? Hospice care, but more facility care. So when we look at a skilled nursing facility, on average across the country, we're talking about an expense on an annual basis of about $115,000 a year. Right now, again, if we think about that, that's $316 a day to put that in perspective. Now, we happen to live in one of the more expensive areas within the country for a lot of things, including care. So if the national average for a nursing home is $316 a day, understand that the average cost a day in New Jersey is $508, right? So if you extrapolate that out, $508 a day in a private room in a nursing home equates to $185,000 a year currently in the state of New Jersey. Right? It's about $15,000 and change a month. So again, I think that really exemplifies why this has become such a hot topic, right? As we're living a lot longer, we're seeing the need for care grow dramatically, right? I think more and more people have firsthand experience seeing mom or dad or their grandparents require care, and they're seeing the cost of what that care looks like, especially if it's in a facility. If you look at an assisted living facility, again, average cost nationally for assisted living is 65,000, 65,558. Again, that breaks out to about 5,400 a month. But if we look at New Jersey, that 5,400 a month in New Jersey jumps up to 8,300. Right. So again, assisted living on average in our neck of the woods, you're talking about $8,300 a month. Or if we look on that as an annual expense, you're talking about just over $100,000 a year today for an assisted living facility. Right. Again, I think this is a one-bedroom apartment in an assisted living community. And then finally, home health care. Right now, what we're looking at in terms of these expenses, that $95,000 a year, that's 60 hours a week. That's not 24/7. That's not a skilled nurse. That's a home health aide. So the example that we're seeing on the slide is about $30 an hour, 60 hours a week, right? So that's where we're getting that expense of about $95,000 a year. Again, just to bring that into our backyard, the average cost of home health care in New Jersey, $37 an hour. So again, if we're looking at that same 60 hours a week, the cost for home health care in New Jersey is about 106,000 a year right now. So think about that, right? Again, that's the expense. And it's important. We don't want to dwell on the expense of this, but I think it's important to understand what we're up against, right? Why has this become such a hot topic from a financial planning perspective? The average individual buying long-term care today is 54. The average individual utilizing these policies, triggering these policies and gaining access to their benefits is closer to 83, 85, right? So you're talking roughly a 30-year time frame. So if these are the expenses today, what might those look like when clients that are buying policies today? What might that look like for them with inflation, right? And conservatively, we would say inflation from a healthcare expense, from a long-term care expense, I mean, that could be anywhere from 3 to 5% conservatively. And then you also look at the average length of your typical claim when a client needs care. You're talking between 3 to 4 years, right? So again, from a financial perspective, it's become more and more likely, right? As we've talked about, people are living longer. The most common statistic we find of individuals requiring care, it's 70%, right? So if you reach the age of 65, you now carry a 70% likelihood of requiring some form of long-term care. So it's high probability the longer we live. We just talked about the expense, right? The expense is significant and it's going to grow certainly over time. And we talked about the duration of that expense lasting anywhere from 3 to 4 years. So clearly this is a significant risk, a significant challenge for many people as we enter into retirement. And again, that's why it's so important to be proactive and to try to put some plan in place. Now, Pat, just to kind of finish with your question in terms of how do we think about using that information to build a plan, I would just, right, it's never too early to do it. In fact, the earlier we can address a planning issue, the better, because you're not dealing in crisis mode. But 3 questions that you really want to ask yourself, and the answers to these questions are certainly going to be individualized to the individual we're speaking with. But who's going to provide this care, right? We're hoping to put together a financial plan to help offset the cost of that care. But the care plan is up to you and your family and your care provider. So who do you want to provide that care? Is it family, right? Are you hoping to be at home? Is there a community that you have in mind that if you needed care, you'd want to be in that type of a community setting? Where would you want to receive that care? Again, that's building off of the last part of this, right? Not only, again, who's providing that care, is it a home health care provider? Is it a nurse? Again, is it a family member? But where's that care being received? Do I want to age in place? Is there a community aspect that I'd like to bring into this? And then most importantly, how would I pay for it? you've got to ask yourself the tough questions. If the need for care arose today, if I look at my portfolio and the way that it's currently constructed, what would be the asset I would turn to first, right? How would I pay for that care? Do I have a plan in place? And have I communicated that information to the people that I love in terms of my family and friends? So again, we can certainly build off of this, but hopefully that helps answer your question.
No, that's super helpful. Thanks, Andy.
Yes.
And candidly, I think some of our clients have a negative perception about long-term care planning. It's usually two things. It's either they feel like they're betting against themselves, or they've heard of rising premiums. Can you talk to us a little bit about maybe how the policies have evolved and addressed some of those issues?
Sure. Yeah. So when we're looking at different ways that we can build a plan, right? I think when you talk to a client that has a concern over rising premiums or betting against myself, right? If I don't use this, I've lost it. Did I throw that money away? What's the opportunity cost? What might I have done with these dollars otherwise? I think really what those concerns are centered in are what we refer to as traditional long-term care policies. So let's kind of walk you through your options. I'll freeze in that area of traditional long-term care, David, to really address those concerns, those comments, and then we can talk about where these policies have kind of evolved, and then maybe take a deeper dive into that. So again, we already talked about Medicare, right? Medicare is extremely limiting. Medicare is not designed for long-term care, but Medicare can pay for limited amounts of long-term care. Important for everyone to know the prerequisites for that, right? There's got to be prior hospitalization. So a client, a patient, would have to be in hospital for at least 3 days or more. And then once released from that hospital, would have to find themselves in some type of skilled nursing situation in order for Medicare to pay anything towards a long-term care. And even then, Medicare would be limited to no more than 100 days. So again, plenty of prerequisites that would have to be met. But even if you're able to meet all of those, the most that we can receive from Medicare for any type of long-term care is 100 days. All right. Medicaid, we're not going to get into much today. That's more of a conversation with maybe you guys, an estate attorney, or an elder law attorney. But again, Medicaid is limiting funding for really individuals, and it's funded through the state, through the federal government, but it's really for individuals that are living at poverty levels, in order for them to have some level of care, in which case Medicaid would be covering the cost of that care. But again, that requires, from a financial standpoint, either a spend down in assets to poverty levels, or just an individual that unfortunately has those kind of financial constraints, and that's where Medicaid might kick in. So that's probably a conversation for another day. Then you look at family, right? Family, unfortunately, covers about 80% of unpaid care providers at home. Now, I think a lot of that is because so many of us don't want to address this concern. So many of us have not put any type of formal plan in place for this potential reality. And while the idea of family being a care provider sounds wonderful in terms of just that connection and feeling, just the self of the feeling that self of, I don't know, purpose of being able to provide care for a loved one, you have to keep in mind, right? When a family member is caring for another family member, that individual, that care provider, is twice as likely to deal with anxiety, depression, and stress. 1 out of every 4 care providers, when dealing with an ill parent, 1 of every 4 will develop some type of chronic illness directly related to that care providing. So when you look at family care providers, what I typically hear, David, Pat, I think you guys hear the same. Once a family goes through that and they see what that does in terms of the chaos that ensues when an illness strikes, what we tend to find is they come to us and they ask, what should we be considering? We don't want to do to our kids what our parents just did to us, right? We don't want to be a quote unquote burden to our kids, whether that's financial, whether that's emotional, or whether that's physical. So again, family's great. There's even policies now that are available that you can use to help pay a family member care provider, and we'll certainly speak to that. But I think many people, if they're proactively looking to put a plan in place, it's so that they're not relying on their family in that position. So now you get to traditional long-term care, right? Traditional long-term care, legacy long-term care seems to be where a lot of those concerns, David, that you had just mentioned are rooted in. Traditionally, long-term care insurance was always built similar to auto insurance or homeowners insurance, or if you're familiar with term life insurance, right? It was this use it or lose it proposition. I pay a premium, I pay that premium on an annual basis in perpetuity, either until I require care or until I pass away. But it was this renter's proposition similar to auto insurance in the fact that if I don't get in an accident out there, it's not as if my insurance carrier is going to write me a letter saying, thank you, Andy, for your wonderful driving record. Here's your money back, right? The premiums that I've paid stay with the insurance company. It turns into a pure expense. And really all that I had was peace of mind. All that I had was the knowledge that there was some type of financial benefit to help offset the cost of replacing or repairing that car, or in this case, a financial benefit to help offset the cost of my care. But if I didn't use it, I lost it, right? Getting back to that whole, I'm betting against myself. I'm putting all of these premiums for the next several decades into a policy that I hope against everything else I never use. And if that's the case, all of these dollars are lost. But in addition to that, what you had mentioned is increasing premiums. Traditionally, the legacy policies also were never sold with any level of a guarantee. So the premiums that the client would agree to pay or the benefits those premiums would purchase could be changed. The insurance company always reserved the right to revisit their pricing assumptions and petition the state for relief if and when they felt like they needed it. So unfortunately, what we have seen is an environment, as we've said now several times, people are living a lot longer. That longevity is the greatest risk driver when it comes to this challenge. We've seen that longevity raise the usage of these policies dramatically more than what insurance companies anticipated. We've also seen advances in medicine and technology. So where insurance companies thought if a client needed care, they might need it for a year or two, when in reality, their claims experience has been double that, with the average claim, as we had said, lasting close to 3 or 4. And then we've also seen tremendously low interest rates in bonds and cash alternatives for a long period of time, which again makes it very difficult for insurance companies to maximize their returns on the premiums being paid. And what that led to was these insurance companies petitioning the states like New Jersey and asking for relief. And that relief would always come at the expense of the policyholder. Clients that have been paying premiums for decades that now might be in their 70s and closer to the need were getting letters from their insurance companies telling them that they would either have to pay a higher premium to maintain their coverage, or if they wanted to pay a premium similar to what they were paying, they would have to reduce their coverage, right? So a lot of moving parts. And what we had found is the traditional model for long-term care became more and more difficult for people to embrace. I don't want to pay for something the rest of my life that I hope I don't use, in which case those dollars are lost. I'm betting against myself, as you had said. And they didn't like the idea that the premiums they were agreeing to pay could drastically change over the next 5, 10, or 15 years, or 30 years from now when they needed the coverage, the benefits might pale in comparison to what they thought they had secured. So what a lot of clients would do is say, thanks, David, but no thanks. We'll self-fund. We'll cross that bridge when we get there, right? We're just going to keep the money in our portfolio. We're going to hang on to it tightly. And you know what? If we need care, we'll address it at that time. And that's really what brought about this next box called hybrid long-term care insurance. Hybrid long-term care was first created 35 years ago. And what hybrid long-term care did was it infused ownership into that proposition, right? The primary goal was still, how do we address a long-term care event down the road? The primary goal was still, how do we create as robust of a living benefit as we can to address this expense if and when needed? But it left room for the potential that care might never be needed. So it gave you the ability to name a beneficiary so that any contribution you've made to the policy, if you never needed care, those contributions would turn into a death benefit upon your passing and pass that premium back to the family in the form of a tax-free life insurance payout. So when you see something like hybrid long-term care, sometimes referred to as asset-based long-term care, it really means the combination of both a long-term care policy and a life insurance policy in one. Now, the other things that the hybrid brought to the table was one, a contractually guaranteed policy so that the insurance company can never come back, regardless of claims experience or interest rates or market performance, and ever ask the client for a penny above and beyond the premiums that they agreed to pay. So it created some certainty where there previously had been none. And then also what it did was it did away with lifetime premiums by and large. Now there's still some hybrids that have lifetime premiums, but what we've seen is this shift more towards defined contributions, right? Let the client structure a premium that fits into their financial situation. If they've got money sitting in cash, or they just sold a home, or they just had a bond come due, if they want to write one check and be done with it as a single lump sum premium, fine. That's how hybrids started. But they've evolved to allow the client the flexibility of paying premiums over 5, 10, 15 years. The point is they would design a premium schedule that fit into your client's situation from a cash flow standpoint. There was a light at the end of the tunnel. They're not paying that premium forever. And the premiums they agreed to pay were fully guaranteed, never to change. So again, the hybrids really became, as of 2012, and continue to grow, the more popular way for clients to address this risk, because they like that idea of having guaranteed premiums. They like the idea of saying, look, if I never need care, there's some type of benefit that gets paid to the family to make them whole again. And again, they like the idea that these hybrids also have what's called a cash value. If I change my mind, if I want to walk away from this and repurpose these dollars towards something else, these hybrid policies give you the ability to cash out the contract and receive either all of or significant portion of the premiums that you've paid. So that's kind of an easy way, high level, to look at the various types of strategies. Now, traditional long-term care comes in many shapes and sizes. Hybrids come also in many shapes and sizes, right? The goal, I think, of this call is to make sure that anyone participating is aware of how these policies have evolved. We can certainly take a deeper dive into these hybrids in a moment if you'd like to, but we want to make sure that you're aware of what exists. So if any of these seem appealing to you, we can certainly take a deeper dive, on a more one-to-one basis. So I'll pass it back to you, David, and see if you want to take a deeper dive into the hybrids, or if there's another question. I just want to save myself from rambling too much.
No, I think we've had a lot of success over the past decade with you with the hybrid stuff. Maybe if we just do a very high level example, Andy,
Sure.
to kind of go through that, and then also you had mentioned the one-time check or the lump sum, talking a bit about how we could structure those payments.
Yeah.
If someone were interested.
Yeah, absolutely. Right. So from a really high level, and then I'll take it a step further. Right. So here's what we mean in essence with a hybrid contract. So you're purchasing a policy. It's ownership. Right. So again, think traditionally renting. Now, the benefit of renting is it tends to come with a lower cost. Right. If you're renting anything, again, because you have no equity in that, it tends to be a lower cost, similar to traditional long-term care. If we're looking at a hybrid policy, you're truly purchasing something, right? There's equity in that agreement because, as this chart shows, either you need care or you don't, right? If you don't need care, there's a death benefit that's tax-free. It takes on the same tax advantages of any life insurance policy because, per the IRS, that's how these policies are viewed. They are life insurance. So there's a death benefit associated with no need for care. Or the other end of the spectrum is that you do need care, in which case the policy provides a multiple of any contribution you've made in a completely tax-free environment to help offset the cost of what that care might look like. So high level, that's what you've got. But let me see hold on, let me just stop sharing because I have a sample illustration that might give you a better understanding of what this looks like, because I think people always are itching for, give me an idea of some number. So here we go. Just give me a thumbs up, David, when that's up on there.
Yep, you're good.
Okay. So here's what I did, right? So I ran some numbers. Now I chose a 63-year-old female client, right? I said the average age client is in their mid 50s. Again, these types of policies can be purchased in your 30s all the way through 80, right? So 63, I wanted to give you an idea of somebody kind of right there in that sweet spot. I chose a female client for this example. Why? Women are more likely statistically to require care, right? We've said it now several times. Longevity is the greatest risk driver when it comes to this particular challenge. Women statistically live longer than men. Women account for 65% of long-term care claims. When women need care, they tend to need it for roughly a year longer than men do. And then lastly, you think about, again, Alzheimer's dementia. Women account for 2/3 of Alzheimer's cases in this country. So they're much more likely to require care. Therefore, they're more expensive to insure. So I wanted to give you an easy example, 63-year-old female using one of these hybrid policies. Now, the hybrid policy that I chose was a fully guaranteed contract, right? Fully guaranteed, as it says at the top, right? All values and benefits shown are guaranteed. So I think what people like about this version of these hybrids is that we can provide you with a roadmap, like I'm about to walk you through. It can take you from your current age, in this case 63, all the way to 125, right? So think about it like it's a dare, right? But we'll show you every year for the rest of your life exactly what your benefits will be. So we can sit down and create some certainty around, what if I need care at 75 or 85 or 102? We know exactly what we've got. What if I pass away at 97 having never required care? What does my wife or my husband or my kids receive? And then lastly, what if I just change my mind? So again, that's one of the benefits of having this type of a hybrid contract. So here's what I did, and hopefully this gives you an idea in terms of like how customizable this can become. So I backed into an initial benefit of $6,000 a month. Like, why? We talked about the average cost of home health care in New Jersey, $37 an hour. So if we were to extrapolate that out, imagine having a home health aide, $37 an hour at your house, Monday through Friday, 9 to 5, right? So 40 hours a week, assuming a 4-week month. If we do the math, that gets you to roughly $6,000 a month. So very rarely when Pat and David and I sit with a client, very rarely are we looking to eradicate the cost. We're not looking to cover the entirety of a nursing home. We're not looking to cover the entirety of a home health care provider, coming to your house 24/7. What we're looking to do is add a meaningful hedge against these expenses, right? How do we take pressure off the portfolio to free up assets and protect? So if we were to back into $6,000 as an immediate monthly benefit, and we were to stretch those premiums over a period of 10 years, right? So again, you can go shorter, you can stretch it over a longer period of time, but just to put something on paper, I ran this with an annual premium over a 10-year period, right? So in this situation, you're talking about an annual premium of $13,995. Again, total of 10 years, you'll see underneath the plan premium, nothing but zeros after that. Lincoln, the insurance company in this case, could never ask for another cent above and beyond the premium you paid for. But that $140,000 creates 3 different benefits in terms of how this client can utilize this policy. First and foremost is the long-term care, right? So by her committing that $139,000 with that premium in year 1 of $13,995, immediately this policy is able to multiply or leverage the $465 in long-term care benefit. So think about that 465 as that's this client's long-term care bank account. If the call came in and all of a sudden you're bringing someone into the home to help, you with those activities of daily living, this is that first line of defense that David and Pat are turning to. So that 465, every cent of that is completely tax-free. The restriction the insurance company will put on that is how much of that 465 you can spend in any given month. And that's where we go back to where we started. That's your $6,000 a month. Now, this policy, you're buying a finite dollar amount. meaning that 6,000 isn't available to you forever. That 6,000 is available to you every month tax-free until you've exhausted that 465,000. So if we look at this policy and it says it at the top of the screen, it would take you 6 years, right? So again, there's wiggle room there, certainly longer than the average need. We could look at something shorter. We had to put something on paper. But if you're spending every cent of that monthly benefit continuously, it would take you 6 years to fully exhaust that $465,000 benefit. Now, when you're building these policies, again, the eyes are on the prize of when the client's more likely to need care. 63 is not a likely scenario of this client requiring care. As we'd said before, it's more in your mid to late 80s. So built into this policy, you've got a guaranteed inflation rider, right? In this situation, that premium paid for a 3% compounding guaranteed inflation. So year over year, whether she's using the policy or not, the benefits that have yet to be used will continue to grow every year at 3%, and that is guaranteed. So when I look at this chart, I can say, what if this client doesn't need care at 63, but rather at age 85? We can see by looking at this chart, the 139,000 she put in is now guaranteed to be worth 892. Her monthly benefit that started at 6,000 is now over 11,000. It's 11,497, and that's the benefit that she would have available no matter what, right? Unless, of course, she needed care before that. But that level of predictability is really what those clients that have gravitated towards this type of planning have appreciated, right? You look, for instance, David, at this other column where it says IRR, stands for internal rate of return. What that means is if we took that same 139,000 over that same 10-year period and went and invested that, how much would that investment have to earn over that 23-year period to create that same 892,000? Well, you're talking about 9.1%. So that investment would have to have an average return a year of 9.1%. Now remember, this is completely tax-free. So depending on this client and their tax bracket, we're well into the double digits. So again, now if you're investing this and chasing a double-digit return in order to achieve this level of benefit, you're going to have to take on some significant risk to do it. And the client's going to have to be really disciplined, regardless of the volatility they see for the next 20 plus years, to stay put. Whereas with this, I think, again, the attractiveness of the policy is to say, look, if I get sick, I've now taken money that might have otherwise been in a conservative investment because it's my emergency money. And now if I get sick, this becomes one of, if not the better performing assets in my entire portfolio. And I've done it without having to take on risk because it's fully guaranteed. If the client never need care, you can see there's a death benefit, right? So she put in 139. She's got a death benefit of 144. Now, again, this version of the hybrid purposely suppresses that death benefit. I'd say it robs from Peter to pay Paul. It's suppressing the death benefit. The clients that are purchasing this version of a hybrid have probably outgrown the need for life insurance. Their kids are grown, the mortgage is paid, they're no longer concerned about a premature death. Their bigger concern is that they can see ahead this long life, and their concern is what that might mean for their health. So there is a death benefit. The clients like to know that if care is not needed, every contribution they've made is going to pay back to their family. But again, it minimalizes the death benefit because the focus of this type of a contract is really more on the living benefit, the long-term care. But if this client never needs care, death benefit of 144. If she were to need care, the death benefit doesn't just disappear. If she needs care, the death benefit would just be reduced dollar for dollar by what was spent. So in this example, if she spent $100,000 of long-term care before passing, the death benefit of 144 would be reduced by the 100, and the remaining 44 is what goes to her family. And then the last part of it was the surrender value. So I just highlighted everything accidentally. The surrender value right here is if the client wanted to quit. Now, it's the least likely outcome. It's the worst financial outcome. There's a lot of different ways to play around with that surrender value to make it greater if they wanted to. I went with the basic surrender value, which in this example is 70 cents on every dollar, meaning any dollar that's contributed to the policy, if the client woke up one day and just wanted to quit, 70 cents of that dollar, never a penny more, never a penny less, is always liquid to them. So again, it's not if they die, it's not if they need care. This is purely if they woke up one day, were no longer concerned with care, the ability to recoup 70% of the premium is also something that's built into these types of policies. So hopefully that gives you a better understanding of what a hybrid policy can look like. Again, this is just one version of what they look like. There's many different avenues of which we can go. But again, I'll stop there and see, David, what your thoughts are.
No, I think that's perfect. That's exactly what I was looking for. And I think from a funding perspective too, Andy, I know you touched on this briefly, but there's numerous ways you can do it, right? So in this case, you could choose to fund it all up front for 139,000. You could do it over the 10 pay, or you could do a hybrid, right, of a larger lump sum up front as well as monthly payments thereafter.
Absolutely.
So you guys are flexible from that perspective, which is nice in clients like that.
And even thinking, David, just sorry, one other thing that I would add, right? I mean, we had said before, clients might outgrow the need for life insurance. Well, they might have purchased life insurance previously when their kids were young, and now they're carrying this policy that has a cash value of some significance. Again, another way to fund these types of policies is that you can, because that's life insurance, so is this technically, you can actually repurpose the cash value from an existing life insurance. Again, if your priorities have shifted, you bought that when a premature death was a concern. You wanted to make sure the kids could still go to college, that the family could stay in the family, even if mom or dad passed away. Well, now we've outgrown that concern. The cash value of that policy could be repurposed or transferred into a contract like this that reprioritizes more towards the living benefit. So to your point, when you talk about a hybrid where maybe there's like a down payment in year one and then smaller payments thereafter, many times that's the structure that we see when someone's maybe transferring from a permanent life policy to more of a hybrid long-term care.
No, excellent. Pat, you have anything else?
No, I thought that was good. I was going to ask about the structured payments as well. So I think that was covered. Do we want to open it up to questions for any of the attendees? If anyone has a question. I see Tanya has a question here.
Can you hear me?
Yep, we can hear you, Tanya.
This is really great. Thanks, guys. Appreciate it. I have a couple of things I just wanted to clarify. So this type of insurance can be used at any age and does not have to wait for a certain age to utilize it. Is that a correct statement?
That's correct.
Okay,
Yeah,
so
I mean, yeah, sorry, you go.
no, go ahead.
No, I was just, the typical age just happens to be in your mid 80s, but there's no age restriction on the policy. So if God forbid something were to happen in your early 60s, right? Because it doesn't have to be permanent. So you think about someone might stop and start a benefit for something like a cancer or a hip replacement. You know, that might be a reason why someone could utilize a policy earlier and then maybe even recover and go off of claim and wait for another instance. But yes, it's a long answer to your question. There's no age mandate in terms of how old you have to be in order to gain access to the benefits.
Okay, that's really good. And you answered my second question was like, can you use it multiple times? So that answered my question. So I've taken care of my parents, both of them. They both passed since, and they both did not have long-term care insurance. So I took care of both of them, and they, you know, it was a struggle. And the reason I asked about the age is I had a brother who had ALS. So not that we have any reason to believe any of the rest of us will get that, but it's just a curious. He was on Medicaid, so that helped to pay for it, but
Sure.
It did not cover the nut. So that answers that question as well. So okay, those were my two.
So Tanya, I mean, I appreciate you, being brave enough to ask a question, right? It's not always easy in this type of a setting. What I would also say, with a lot of these hybrids, they don't go into family history. So I've done a lot of business with individuals whose mom or dad might have had dementia or early onset, and they're living with this fear of, man, when could that diagnosis potentially come my way? When you go through the underwriting process on many of these contracts, it is about your own personal health history. They're not getting into family history.
Okay.
I know the policy that we're looking at right now from Lincoln, which is the company I work for, does not send someone out to do blood work or put you through a physical. They're not looking at full medical records.
Okay.
It doesn't mean that it's automatic issue. It just means it's streamlined. You would go through an interview process online or over the phone to determine whether or not you can get the policy, but family history will not come into play.
Okay, that's good clarification as well.
Cool.
All right, great. Thank you. Very, very helpful.
Excellent. Thank you. I'll throw something out there if we're still waiting for another question, just in terms of how these policies have evolved, right? So you're looking at a hybrid, kind of the flagship, the pioneer of these hybrid policies. Now, again, there's hybrids that are more focused on death benefit if that's bigger concerns, or there's ones like this that, again, are more geared towards the living benefit. But what we have also seen is because of that dramatic shift, right, we had mentioned earlier that the average age client buying long-term care today is in their early to mid 50s, 54. If I've got a 30-year time frame ahead of me, there's the latest evolution of these hybrids have allowed for market participation, right? So in essence, you'd be giving up some of the predictability that we're looking at here with a fully guaranteed policy for the potential of what the equity market has the ability to provide, right? Thought process being financially, any financial chart you look at, when you're looking out 15, 20, 25, 30 years, it would tell you that equities is probably the best place for you to be, especially if we're looking to hopefully keep pace or outpace the cost of care and healthcare. So again, just keep in mind, if you're on the younger side, right, you might not be 63, maybe you're 53, maybe you're 45, you had experience with mom or dad. There's policies that, again, could allow you to keep your money in the market, allow that money to work for you. Think about it almost like it's an adult 529 plan, right, to be clear, but for long-term care expenses. That same thought process of, hey, let's use the next several decades to utilize the equity markets and what it brings to the table, but allow those dollars to grow completely tax-free on the way up. If and when I need care, the dollars come out completely tax-free as a hedge against those expenses. And then the death benefit of those policies would include any of that equity-driven growth. So if you're 53 and you pass away 30 years from now, having never needed it, it's not just going to be a return of the premium, but it would be all of that equity growth that we've experienced during that 30-year period would be included in the death benefit as well. Now, again, it's an insurance policy, so there's floors, there's downside protection, all of those things which we can get into. But I just would be remiss if I didn't mention that these policies have continued to evolve to incorporate equities if the client is comfortable with that approach.
Thank you, Andy. It doesn't seem like we have any other questions here, so I think we could kind of close it out.
Excellent. No, appreciate the time and appreciate you guys bringing me on board for this.
Of course, thank you. We appreciate your time.